You think a 72 or 84-month loan is smart because the monthly payment looks lower? Here's the truth. You're buying that car with your future. The moment you stretch a loan from 60 to 84 months, sure, your payment might drop. But what you're really doing is locking yourself in longer, paying more interest, and massively increasing the risk of going underwater, meaning you owe more than the car is worth, right when that car is depreciating the fastest. And here's the scary part. In the US, 84 months and beyond is becoming the new normal. So today, I'm going to break down three things dealers won't tell you: what you'll actually pay, how you get trapped, and how to get out without blowing up your finances. Here's why 72 to 84-month loans have exploded in the US. Cars got expensive and money got expensive. When prices climb and interest rates stay high, people stop shopping for a car and start shopping for a monthly payment. Look at the reality right now. The average new car payment is about $748 a month, and even used cars average around $532 a month. For a lot of households, that's not a car payment anymore, that's a second housing bill. So the industry offers the magic trick: stretch the term. Take the same price tag, spread it over more months, and suddenly the payment looks manageable. That's why we're seeing a record share of buyers signing up for 84 months or longer, about 22.4% of new car loans. That's not a niche behavior. That's becoming normal. And once a long loan becomes normal, people stop asking, "Is this a good deal?" and start asking, "Can I make the payment?" That mindset is exactly how the trap starts. Here's truth number one. A lower payment is just time magic. You're not making the car cheaper. You're stretching the pain. Let me show you with a clean example. This is just math. Your exact numbers will vary, but the pattern is the same. Say you finance $40,000 at about 7.2% APR. That's roughly where new car rates have been sitting. At 60 months, your payment is about $796 a month, and you'll pay roughly $7,750 in total interest. Stretch it to 72 months. The payment drops to about $686, but total interest jumps to around $9,378. Push it to 84 months, the payment falls again to roughly $608, and now you're paying about $11,041 in interest. So yes, going from 60 to 84 months can save you around $188 per month. But you're buying that discount by paying about $3,300 more in interest, and you're staying in debt 2 extra years. And here's the part most people miss. Those extra years aren't neutral. They're the years when life happens. Job changes, layoffs, medical bills, moving, kids, while your car is getting older and worth less. A longer term doesn't just change the payment, it changes the risk. Truth number two. A 72 to 84-month loan can turn you into a hostage to your car. Here's the simple reason. Cars lose value fast, but your loan balance drops slow, especially in the first couple of years when a bigger chunk of your payment goes to interest, not principal. So while your car is depreciating month after month, your debt isn't shrinking nearly as quickly. That gap is where people get trapped, and it usually shows up in two painful ways. Trap number one. You want to sell the car or trade it in, but you can't. Because when you check the numbers, the car is worth less than what you still owe. So you're stuck. You either keep paying or you find out the hard way that selling doesn't wipe the slate clean. Trap number two. Life hits you. Maybe you lose a job, your hours get cut, childcare costs spike, rent jumps, whatever it is, your income drops. But your payment doesn't care. With a long-term loan, that payment is there for years, which means one rough season can turn into a financial emergency. And this isn't rare. In the real world, it's common. One recent data point showed about 26.6% of trade-ins on new car purchases were underwater, meaning the owner owed more than the trade-in value. Let me define that in one line. Being underwater, or negative equity, means your trade-in isn't enough to pay off your old loan. So you either bring cash to the table, or you roll the leftover debt into the next car. And once you roll debt into the next loan, The trap multiplies because now you're not just financing a car, you're financing your old car's mistake too. Truth number three: when you stretch the term, you usually inherit three hidden costs, and they don't show up in the monthly payment quote. Checklist: remember these three. Number one, insurance gets more expensive. When you finance a newer or more expensive car, the lender typically requires full coverage that's comprehensive and collision. And the more the car is worth, the more you usually pay to insure it. So even if the loan payment drops, your total monthly car cost might not.
Number two, GAP insurance. A lot of people end up buying GAP because they know the risk. If the car gets totaled or stolen, the insurance payout might be less than what you still owe. GAP covers that difference. Long loans make that situation more likely because you stay closer to underwater for longer. Number three, maintenance and repairs rise while you're still in debt. With an 84-month loan, you're committing to payments deep into the years when cars start needing tires, brakes, batteries, major services, sometimes unexpected repairs. That means you can end up paying a car payment plus repairs on a vehicle that's no longer new, while the loan is still very real. So the bottom line is this: you think you're only adding 24 months. But in reality, you're adding 24 months of risk. Risk that your income changes, risk that your car's value drops faster than your balance, and risk that costs pile on while you're still trapped in the loan. So why do people still choose 72 to 84 months? I'm not here to judge anyone because I get it. Most people aren't trying to be reckless. They're trying to survive. The real reason is simple. They're solving a this-month problem, not a total cost problem. When your budget is tight, you don't ask, what's the smartest financial move over 7 years? You ask, can I make this payment next month and still pay rent? And that mindset creates three very common psychological reasons. Number one, I just need the payment low enough to get approved. A longer term is an easy lever. The dealer can drop the monthly number without dropping the price. And for someone worried about approval, that feels like progress, even if it's expensive progress. Number two, this car is safer for my family. That one hits deep. People will stretch their budget because safety feels like a moral decision, not a financial one. And the industry knows it. They'll position a bigger, newer car as responsible, even when the loan structure is what creates the risk. Number three, everyone's doing it. When 72 and 84 months become normal, it stops feeling extreme. If your friends have a $700 payment and the average is pushing up, your brain starts to accept it as the cost of modern life. But here's the key. Normal doesn't mean healthy. So the question isn't, can you get the payment? The question is, are you being pulled into the trap without realizing it? Let's break down the signs so you can spot it before you sign. All right, here are 5 signs you're buying more car than you can actually afford. And when I say afford, I don't mean you can make the payment this month. I mean you can handle it without sacrificing your future. Sign number 1. You only make it work at 84 months. If the deal collapses the moment you shorten the term, that's your budget telling the truth. The car is too expensive. Sign number 2. You need 0 down or a very small down payment. Now, I'm not saying everyone needs a huge down payment, but if you're putting nothing down because you don't have it, you're starting the loan with no cushion, right when depreciation is hitting hardest. Sign number 3. You're rolling old debt into the new loan. If you're underwater on your current car and the dealer says, "No worries, we'll wrap it in," that's not a solution. That's debt recycling. It's how people end up paying for yesterday's car inside tomorrow's payment. Sign number 4. The dealer asks, "What monthly payment do you want?" before they talk about the out-the-door price. That's the biggest red flag in the room, because once they anchor you to a monthly number, they can manipulate the term, the interest rate, add-ons, and fees until the payment fits, while the total cost quietly explodes. Sign number 5. Your payment plus insurance leaves you with no room to save or invest. If your car takes the place of your emergency fund, retirement contributions, or basic breathing room, it's not transportation. It's a financial chokehold. Because here's the truth. A car isn't supposed to be the reason you can't build wealth. It's supposed to help you get to work, not keep you working forever. Now let's get practical. Here are 4 simple rules that will keep you out of the 72 to 84-month trap. No finance degree required. Rule A. Buy the car by the total cost, not the monthly payment. Your job is to control the deal, not react to the payment. Every time you talk numbers, ask for these 3 things, in this order: out the door price, APR, and term. Out the door means the real total, including taxes and fees. If you don't have those 3 numbers, you don't have a deal. You have a magic trick. Rule B. Set your own payment cap based on your income before you step on the lot. Here's the easy way to do it. Think in terms of your total monthly car cost, not just the loan. That's payment plus insurance. And for some people, parking, tolls, and charging or gas. Pick a percentage of your take-home pay that keeps you comfortable and still lets you save and invest. The exact percentage depends on your situation, but the principle is universal. If the car crowds out your future, it's too much car. Rule C. Avoid trading in a car when you're underwater, if you can. Because when you trade in with negative equity, you're not starting fresh. You're packing old debt into the new loan. That's how a normal car turns into a 7-year financial hangover. Rule D. If you must take 72 months, treat it like a temporary bridge, not a lifestyle. Sometimes people have a tight season in life. If 72 months is the only way to keep transportation reliable, fine, but then you need a plan. Your goal should be to pay it like a 60-month loan by sending extra money directly to principal whenever you can. And if your credit improves or rates drop, you look at refinancing to shorten the runway. Because the best version of a long loan is the one you don't keep long. If you've already signed a 72 or 84-month loan, don't panic and don't beat yourself up. What matters now is what you do next. Here's a practical, no fantasy exit checklist. Step 1. Find out if you're underwater. Look up what your car would realistically sell for today, not the wishful price, and compare it to your current loan payoff balance. If the payoff is higher than the sale value, you're underwater. That one number tells you what moves are safe and what moves will trap you. Step 2. Start paying extra toward principal. Small amounts count. Even $50 to $100 a week can change the timeline dramatically, because it hits the balance directly and reduces how much interest you pay going forward. The key is making sure your extra payment is applied to principal, not just pushed forward as next month's payment. Step 3. Don't trade the car while you're underwater. Trading in underwater is how people turn one loan into 2 problems. If you want a different car, the financially clean path is to get the balance down first. Then you have options. Step 4. Refinance when your credit improves, or when rates drop. If your score is better than when you signed, or the market moves in your favor, refinancing can lower the rate, sometimes shorten the term, and reduce the total interest. Not everyone qualifies, but it's absolutely worth checking. Step 5. If the payment is crushing your life, consider a downgrade. I know it's not fun, but if this loan is keeping you broke, the fastest way out is often to sell the car, take the hit if you have to, and move into something cheaper. Because just survive the payment for 7 years can cost you far more than swallowing your pride for 7 minutes. The goal isn't to have the perfect car. The goal is to get your cash flow back so you can breathe, save, and build. So here's the bottom line. A 72 to 84-month loan isn't automatically wrong. In some situations, it can be a temporary tool. But if you're using it just to qualify for a car you can't truly afford, then it's not a loan, it's a trap. A trap that trades a lower payment today for higher costs, higher risk, and fewer options tomorrow. If this hit a little too close to home, you're not alone. And you're not stuck. You just need the right math and the right moves. So here's what I want you to do. Comment term if you want part 2, where I'll show you how to calculate your maximum safe payment and the step-by-step strategy to escape negative equity without wrecking your finances.